The views and opinions of this program are those of the hosts, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading. Well, we saw tough trading on Thursday. Grains and oilseeds, plenty of double-digit losses. We saw some pressure in the livestock trade as well. Just not a great way to come out of the midweek holiday for Juneteenth. Let's talk about the market action that we saw on Thursday and try to make sense of things. Joining us now, Brian Doherty, Senior Market Advisor at Total Farm Marketing. Brian, it's good to catch up with you again this week. And, well, can we find anything positive to say about the grain trade on Thursday, Brian?
Well, from a pricing perspective for producers, no. That was a pretty rough day again. The charts look pretty ugly. We've had some of our worst closes of the year. And it looks like the bears are in charge. The managed money is likely adding to short positions they began to build 3 weeks ago. You've got a really, I looked at this morning's 6 to 10 day forecast and kind of gulped on that, because it's just, if you're looking for something in the near term weather that would be viewed negative from a forecast perspective, it's hard to find. You got above normal temperatures for the entire Midwest, and you've got above normal precipitation. So sort of a warm and wet forecast. So I know the last thing some farmers need right now is more rain and more wet, but incrementally, you look at the number of areas that are affected through wet weather historically versus the aid that rain produces, and it's pretty tough to make that argument. Think more so, though, the market in corn, maybe beans as well, as there's just that concern that when the spigot shuts off, there's a lot of shallow-rooted crop out there that's going to need more rain. Well, you've got another week to 10 days basically into the 1st of July forecast that looks like growth could be really good and quick for, in particular, the corn crop. Beyond that, all bets are off. The 30-day NOAA forecast did come out below normal temperatures, or precip, and above normal temperatures for that entire eastern corn belt. That could be concerning. So rough day to day, but big picture, not sure that the crop's in the bin yet.
I wonder too, with the weather, that's obviously going to give us plenty of volatility until we get something fresh in the way of news to hit these markets. I think about, next week's USDA reports will be pretty big market movers, but in the meantime, it just feels like it's all tied to weather. But also too, from a market perspective, July options expiration, is that maybe playing a role in some of the added pressure here in the grains this week, Brian?
It could be. Every once in a while, you'll see in the option market where there's a kind of a buildup of open interest in a certain strike price. And, the general thought is that, let's say, there's a big open interest in options, and the sellers of those options could be managed money, right? So they'll want to sell, let's say, corn to get down to that strike price, so the call options lose their value. I don't know if I've ever found a lot of rhyme or reason to that. That's certainly something that's out there, and something to be watched. And we do sometimes see the market seemingly migrate to that strike price that has the highest open interest. But it's a hard conclusion to draw. I think right now you've got three things. One, you've got a technical picture that really looks rough. Two, you've got fund or managed money that are net short, and week to week to week they've been adding. And then thirdly, we haven't seen, look at this month's supply and demand report. We're just not seeing anything in those reports that show us anything but an adequate amount of carryout. So when you get a weather forecast that looks pretty sufficient, the two thought processes are that those who are short are likely to continue to add to shorter sold positions. Two, a lot of farmers need to get rid of stuff, clean out the bins. I think there is some capitulation there. But thirdly, you've got just a technical trend that's down. It makes it easy for prices to fall apart because end users and buyers and speculators, they're not lined up to buy this right now. And it shows on days like today where the market can easily go through levels and hit stop orders and go through, and you don't have lots and lots and lots of buy orders underneath the market.
Thinking about that thought process, I'm sure a lot of farmers don't want to necessarily market when things are going down. When the trend is downward, they get, I would say they get just, not very enthused with where things are at. But at the same time, I feel like risk management, smart risk management, you also kind of have to really take a hard look at some of the tools in the toolbox to protect yourself in case things slip even lower, right, Brian?
You absolutely do. And what's critical there is that when you look at the big picture perspective, Jesse, you're continuing to monitor and look at, well, where are prices, where they compared to where they've been historically? Can they get that much lower again? Sure, it doesn't take a lot to drive prices down, and especially if there's momentum. So you and I have talked about this all year. Since January, prices broke, and they have not gotten back to that level. So we've got a lot of hope and time on our pallet at that point to say, well, we'll just wait it out. But you've still got to look at the calendar and realize that every month you got to quantify what's sold, what isn't sold. And there's two things I'm going to say on this. One is continue to sell into a market during the winter and spring months, because typically the market's going to break at some point. So maybe you can get some rally along the way, but now all of a sudden we're breaking. You don't want to get stuck with a lot of inventory in midsummer and have to almost, quote, give it away. So that's one thing. The other thing is too, if you're not familiar with how to retain ownership, now think about getting things done. We sold, or I'd recommend selling a lot of product early on in the year because it didn't smell right. It looked like Brazil was increasing acreage. There just wasn't a good sign out there. But we also went in and reinvested some of that into July or September or December option strategies that are losing money, but it was better than holding the inventory. And so we created a balance there. So it didn't mean to be long-winded, but that's really important from a marketing perspective to understand what tools are available.
No, and I appreciate the perspective. We'll take the long-winded answer at any time, Brian. Wheat markets very oversold here. It feels like, and Minneapolis wheat's hit 3 years lows. I'll say this honestly: this wheat market complex overall, I'm starting to get the same feeling. It's kind of taking a cue from the hog market, which we keep saying, "Oh, we're going to find a bottom. We're going to find a bottom," and we're just not doing it. It feels like wheat's starting to kind of act the same here due to multiple factors, Brian.
Multiple factors indeed. What bullish news there was got factored in on the way up, and we haven't seen anything more. So what I mean by that is Russia got some rain that was needed. The crop has been downgraded. There may be more downgrades to come, but all of that's considered old news. And when the market breaks through moving averages and it breaks through key support areas, it gets really, really challenging as a farmer to want to be a seller. But you've got to recognize when you break an uptrend, look every week at the weekly managed money reports, the Commodity Futures Trading Commission, and where's the money flow? And the money flow has been building these short positions. And so when money builds shorts, in this case, wheat, the market's going down. You have these poor closes, and then you're waiting for a bounce back the next day, and it doesn't come. Then has another poor close. The money's adding to positions, and wheat has got a problem right now with the idea that the fund money continues to sell. So it's not a blame on fund money. It's just a fact. They're trading the trend and they're trading the fundamentals that just don't have a bullish story today.
Well, and you throw on top of all this too a higher U.S. dollar, and that's going to create a headwind. Our demand, we've talked about this, Brian. Demand's already fairly poor for U.S. commodities, and you inch that dollar index up higher and higher, and that's just going to act as an overall headwind, isn't it?
It is. You've got a dollar that isn't cooperative. You've got stock market that's revived and broken to new highs with the S&P. You got the Dow Jones off a little bit here recently, but you just don't have these cylinders clicking right now. And so that's the challenge in the commodity complex. And unfortunately, there is there's just not a lot of story, and I keep coming back to that concept. Um, and consequently, we're left with sort of this bigger picture perspective that all of a sudden the trend looks down, the funds are selling, the technicals look weak, the crops are not there, but they're not getting smaller. We've just run out of bullets, and that's the environment we're in right now. Could this look totally different next week? Sure. The real weather market, I've always said, starts about June 15th, so we're 5 days into it, and we got a forecast for the next 10 days. Beyond that, all bets are off. There are a lot of problems out there with too wet, and how this comes back to final yield this corn. I think the bulls have an argument that we are nowhere near 181, and we'll see if that plays out. But that's what's on the books right now for the last yield estimate from the USDA.
Brian Doherty, Senior Market Advisor at Total Farm Marketing, is our guest analyst here today on the show. Brian, livestock trade, cattle ended up fairly mixed. We were looking triple digits lower for a bit Thursday and kind of recovered a little bit. I know the trade, we're waiting on cash activity this week. We got a cattle on feed report coming up Friday after the close that
Right.
average estimates look to be fairly neutral. But your thoughts on this cattle market here and just some of the trade action that we're getting this week?
Yeah, the trade action is really interesting because the board doesn't seem to be in conjunction with what cash has been doing, right? And the board, I think, is anticipating. The board is sort of the collective vote outside the cash market, trying to decide whether or not this cash cattle contract can hold up. And the consensus is, according to the board, not quite to where cash prices are. So we still make this supply argument, and that is certainly something to think about, that we're not likely increasing supply anytime soon. I'm going to keep going back to this. We talk about demand concerns and developing new demand markets, and how do we do that with a rising dollar? We probably aren't going to see more exports. How do we do that with high beef prices in an economy that seems to be chugging along pretty well? But at the same time, we hear about consumers that 60% of the consumers are basically living paycheck to paycheck. Where do you develop new avenues of demand? So that continues to be our bigger concern there. And talking to a couple rather large dairies and livestock producers today, I'm echoing their sentiment. They're concerned that what they see around them is an economy that just doesn't look like it has the wheels to hold up and continue to grow as it has, including the stock market, which has been just up and up and up, but has primarily been technical stocks. How long does that last to give consumers confidence? Probably not too long.
You brought up dairy. What's some of the latest you're seeing in the dairy trade, whether it's milk futures, butter, cheese, you name it? And what stands out to you here as of late in dairy?
Well, let's take a step back, big picture. Back in the first 2-3 months of the year, we're seeing, geez, why aren't we seeing demand pour into this market? And then it did. And then when you look back, we had really, really good exports. We've had really solid movement in the product market. Then that slowed some, and now the dollar's back up. At the same time, trying to quantify this whole bird flu issue and whether it has big impact, lasting impact, or it's just sort of one of those things that comes and go. The market doesn't know. So we've got this good push up to higher levels. And part of that's been on continued good demand for products such as butter, creams, things that have more component value. And that's helped to drive the price of class 4 milk higher, because that's fluid. So more milk's going into the cheese and whatnot. Now, a good day today, up about 30, 35, but very volatile in the marketplace. The cheese was off a penny again today. Probably a good story is just the continued longer term uptrend in the butter complex and strong butter prices. And I would argue that those are getting back to levels where they were sort of toward, let's say, mid-fall. But again, I like in the beef market, we question whether or not demand alone can hold up these markets. I had one dairy farmer say, thank God for cheese and thank God for pizza, and maybe that'll be our saving grace. But there's just not a confidence level out there on the entire economics. And I'll tell you why I think that is because we keep hearing about the Fed potentially lowering rates, that the core inflation numbers seem to be going down. Talk to a consumer that goes to the grocery store. There's no sign of anything going down at this point.
There is not. There is not. And Hogs too. I mentioned them a little bit earlier. It's kind of the same sentiments to some degree in Hogs too. I mean, they're all a piece of that puzzle at the grocery store and more. And as far as futures go, it just feels like this hog market tried a little bit early in the week, just can't catch a break. It just feels like hogs have their own fundamentals, but are also kind of caught up in that bigger picture perspective right now, Brian.
I couldn't have said it better. They're just caught up in the bigger picture perspective. You've got an industry there that I think is it's kind of the way of the dairy industry, but it doesn't have quite the liquidity and movement that the dairy market has historically. And that is, you've gotten bigger and bigger and bigger in size. So what happens, and we see this in the dairy industry, when margins get pinched and prices start to get pretty tight, what happens? And what happens is that you produce more. And so that's what the hog industry basically did. It produced more, it got caught, it's still paying the dividends, in this case negative, for increased supply when the demand market can't quite gobble all this inventory up. Now, all that being said, we had a beautiful reversal in the markets last, today's on Monday. I want to say last week. This holiday here is making me think it's Monday. So that's holding off today. I wouldn't say hogs are out of the woods, but they're probably low enough, both on the nearby and deferred months, which are even lower, to curb production, because losses are going to be that big, which take us full circle back to the corn market. Then do we have to start scratching in less corn demand? I would say not yet, but that's certainly potentially on the tablet.
Brian, good stuff as always. Final thoughts for us? Anything you want to mention or reiterate to folks today?
Well, markets go up, they go down. And unfortunately for row crop producers, it continues to look sluggish. This is a function of bigger inventories. And so, lessons learned, keep looking long-term in bull markets. We seem to grow more inventory in the world, quickly responded this year. This past year, you look at something like wheat. When the war broke out, it's like, boy, what's going to happen? What's going to happen in Ukraine? So Ukraine, you talk to people that have been in the country, they say it's a train wreck, it's a disaster. Yes, they're farming, but not nearly to the level where they were. But other parts of the world quickly filled that void. So higher prices do fill voids. So we're always looking long-term, look for carry in the market, look for all the opportunities you can. Burying your head in the sand isn't necessarily the best place to be. I'm not a naysayer. I'm not negative Nelly, but corn prices in December still above $4.50 last year. This past year, we saw March corn trade under $4. If we hold carry out, maybe make it a little bigger. That's one of the problems we have. Other than that, I'm inclined to think that corn prices are going to chop around, maybe edge lower, but we're still entering that weather market. So really, the message is to end users, to buyers, don't get complacent. You're getting an opportunity that probably wasn't expected this soon.
Brian, I know folks will reach out if they have questions for you there at Total Farm Marketing. How can they get in touch with you?
Phone call would be best, 800-334-9779. And then I'll look toward maybe encouraging emails too, if you'd rather go that route. I'm not a big fan of that because I don't always see them right away, but phone call first. Otherwise, Brian with a Y at totalfarmmarketing.com. Please check out our website, totalfarmmarketing.com, see our resources there, and just let us know how we can help, or whatever question you have, throw it at us.
Brian, good to talk with you again this week. Thanks for being with us here on Market Talk. Appreciate it.
Jesse, thank you. Much appreciated as well.
Make sure to subscribe to the Market Talk YouTube channel. You can watch our latest interviews with top market analysts in the country, find bonus content, and much more. It's easy. Just go to youtube.com/@MarketTalkAg and hit the subscribe button. Or you can search for Market Talk Ag on YouTube.